Good morning, everybody. Hope you're doing well. My name is Jeff Gibby. I'm going to go ahead and kick everybody off. Thanks for coming this morning, or this afternoon, or this evening, whatever the case may be for you guys. Welcome. Today's a really interesting topic. I'm actually pretty excited to see it myself. Really kind of like the idea of Ichimoku Cloud charting, but I don't know too much about it. So if that's what you came to learn about, you're in the right place. If this is your first webinar, you're in for a real treat. Part of Forex Trading TV is going to be coming in here. She's going to talk about Ichimoku charts. She's been in the technical industry for a long time, 30 years. And, you know, I just, out of the way, I'm going to let her talk. I'm going to let her kind of give you a bit of a lesson this morning. Okay? So that being said, let's go ahead and get to it.
Right, everybody, I think the screen's been chucked over to me and it's my turn now to speak. So let's kick off, and we're going to learn about Ichimoku Cloud charts today. The webinar is based on a course I've given before for the diploma of the Society of Technical Analysts, which is taught at the London School of Economics here in London, where I am. I'm going to start off with a PowerPoint presentation where we're going to see exactly how to build the charts. Then I'm going to stop for questions, if that's all right, to make sure that you've understood all the different elements involved. And then after that, I thought we'd look at some of current markets as they are now, looking at current markets and how the cloud charts can help you, how they are interpreting the signals at the moment. And again, I'm happy to take questions after that. So if it's all right with everybody, we'll kick off now. And this chart here that's titled Ichimoku Kinko Hyo, which is the full Japanese name for the type of analysis, I first came across 16 years ago when I joined a large Japanese bank as their first full-time technical analyst in Europe. This was in the Treasury division, covering foreign exchange and interest rates, and I was a very, very confident technical analyst with bags of experience. And imagine my horror when I was confronted with this Reuters chart that looked just like a plate full of spaghetti, quite frankly, where half the dealers in the bank were Japanese and half of them were looking at charts like this. The other half had very, very limited command of English, and I had no idea what I was doing, absolutely no idea how to interpret these charts. So let's get cracking and see how we move on. So to my next slide. Right, we'll have to move it up slowly. There we go. This is the Kanji characters, the Chinese characters for Ichimoku Kinko Hyo. The first character here, this horizontal line, that is 1. This funny one here is actually an eyeball on its edge, and it means one glance, so one glance. This one here means balance, and this is mountain. These two together mean the word Kinko. And this one, final one here, is the word for chart, or hue, which is also the word for footprint. Okay, so one glance, balance, mountain, footprint. And roughly translated, this means a balanced instant view of the market taken from a mountain as it leaves its footprint for you to follow. The whole system was developed by a chap called Goichi Hosoda, who was a journalist and investor, and his pseudonym was Sanjin Ichimoku. And he devised this system in the 1960s based on the Tokyo Stock Exchange share prices, and it was all very much through trial and error, laborious back testing, and let's not forget in those days we didn't have personal computers. The whole theory was given a big, big boost in 1995 by a book published by Hidenobu Sasaki. And my colleagues and I at the Japanese bank have pored over it many, many, many times, trying to learn exactly how to work the system, and it is still today one of the most popular of all technical analysis books written in Japanese ever. And as I say, the chap who introduced me to this was, of course, the busiest dealer in the dealing room, the chap who did spot dollar yen. His English wasn't very good then, but he's improved a lot with my help. And he managed to find the time, and my colleagues would translate a lot of what was in the book. And by doing all of this, I eventually wrote a book on the subject myself. Moving down to the next chart. The first element to go on the system are candlesticks, daily ones at that, and I've done the Nikkei 225 here for you. So daily candlesticks, and what you're looking for are a combination of clusters and patterns that we see, for example, this sort of triangle bit here, and this three-legged one here, and this rounded sort of topping one here, just as we do in the West, but also the special candlesticks that we look for in Japanese charts, which were popularized by Steve Nyson many years ago, and his book is still, I think, the head stands head and shoulders above all the others on candlesticks, so I would urge you to look into that. So is the combination of the Japanese ones, like these little dojis, and these bearish engulfing ones, and then just Western concepts with gaps and so on and so forth. So you've got all of that. Also just wanted to mention that the candlesticks themselves were developed by traders on the rice forward market in Osaka in the 1700s. So, you know, technical analysis is really not new. It's been around a long time, as have commodity trading generally, and futures and options on these as well. So think of tulip bulbs in Amsterdam, where we were trading options on these and fractions of bulbs, and later in the 1970s in the Chicago and New York pits, who did a lot to popularize technical analysis. Moving on to the next study that you put on the chart are moving averages. It's a 9-day and a 26-day are the default options on these. Again, these were back tested by lowly paid, well, at least they were paid, they weren't interns, but poorly paid assistants who were sworn to secrecy, and they optimized the time periods manually, okay? And it's a conventional Western moving average system where when the shorter day average, the pink one, crosses above the longer day one, you're long, and when they cross down again, you reverse the position. So you've always got a position in the market. Obviously, with this in mind, you can tell immediately that the moving average and the Ichimoku charts are based on trending markets, and they are no good in sideways markets. Really be very, very careful with that. You can lose an awful lot of money. The shorter moving average is the 9-day. The longer moving average, a 26-day. And this is because at that time, the Tokyo Stock Exchange used to open for business on Saturday mornings. And so the average month had 26 working days in it, and then the 9-day one flicks around by optimization. Now, this is not the moving averages us Westerners know, where we take the closing prices, top them up, and divide by the number of periods. The 9-day moving average is based on the highest price of that 9-day period, to which you add the lowest price of that 9-day period observed, top these two together and divide by 2. Similarly, the 26-day moving average is not 26-day closing prices, and added up and divided by 26. It is the highest price of the 26-day period, to which you add the lowest price of the 6-day period and divide by 2. And you'll see that they're quite different from the Western ones in that quite often they go flat across the page. And what you're looking for, as well as the crossovers, is that the moving average itself acts as support. Notice here how well the 26-day moving average capped the lows and pushed you on up again. Okay, here the 9-day moving average did that. Here the 26-day moving average. So too here. Here they crossed, and the 9-day moving average provides resistance to the candles themselves. Note that with candle analysis, the body of the candle is far, far more important than its whiskers, its spikes, its skinny bits, okay? That's a spike or a whisker. So the true range, or the candlestick, the fat bit, is infinitely more important, and often the spikes are discarded as irrelevant noise. Keep that concept in mind. That's very, very useful for when you're dealing with particularly skittish markets. Okay, so far candles, and we look at the candlesticks themselves and the grouped patterns, the moving averages with their crossovers, and the averages themselves providing support in a bull market, resistance in a bear market. Moving on to my next chart, I then add the interesting bit, which is the cloud itself. Now it gets a little bit more complicated. So just to recap, there's my 9-day moving average. You can see how often it goes flat. If you've got a significant high and a significant low that dominate, that's what happens. Likewise here on the 26-day moving average, it'll last for much, much longer as a particular high and low dominate for a long time before they drop out of the equation. Similar thing here. Right, now the top line of the cloud is formed by, it's called a line called span A, line A. And to calculate that line, what you do is you add the 9-day moving average to the 26-day moving average and divide by 2 and plot it 22 days ahead of today's moving average. So there are the two moving averages, you can see them. They're almost at exactly the same level, and therefore they're plotted here ahead of time. Right? Here they were a little bit higher, and so they plotted higher, and here they're coming down. Okay? So that's span A. This lower one is span B, and although it's got the same name, its calculation is completely different. That is the highest price of the last 52 days, to which you add the lowest price of the last 52 days, divide by 2, and again plot it 26 days ahead of time. And there you have it. Okay, so those are the two lines. You shade them in any color you want, it doesn't matter. And the Reuters charts tend to switch color depending if span A is below span B as it is here, or if span A is above span B as it is here. It actually doesn't matter. What really does matter is how thick the cloud is. The thicker the cloud, the more support it will provide in a bull market as here, the more difficult it will be to break it, yeah, and the stronger the bull trend is likely to be. It also gives you an idea of where you might be in 26 days time, 26 days ahead of now. So it's giving you a steer as to what's going to be happening over the next month or so. Right, when the cloud is very, very thin, right, it's very much easier to break through it, and therefore it is very much easier to see a turn in trend. And this is precisely what happened here at that skinny little bit. Look how it broke through. We found it was a false break and came back, and then the cloud starts kicking in and providing support again. All right, so it's the thickness of the cloud that matters, not its color, not its slope does matter actually. Its slope going forward does matter because it gives you an idea of how much lift you're likely to get going forward. Think about it this way as well. It's sort of in a bull market, you've got clear skies, nothing to impede your rally, plenty of cloud to provide support, off we go. The opposite case in a bear market, where the dark cloud grinds prices lower and pushes you relentlessly down. The distance between the candles and the cloud do not matter. Okay, it does not suggest that you're ridiculously overbought or anything like that. It just means that your support levels are a long way down, and so if there is a dip, you're not going to catch any support for a long way. But it doesn't mean that you're overbought like a relative strength index or anything of that ilk. And the final line on the chart is called Chiku span, or the lagging line, and it's this dark green line that is plotted 26 days behind current prices, and all it is the closing price 26 days ago. So you can see here the little closing prices in that bit are those there, the little upward one, the little bit here, those prices down there are all those in there, and so on. And this one I love because what it tells you is today's price will garner support from all these elements in the chart 26 days ago, just as today's price will garner support from the current moving averages, top of the cloud, bottom of the cloud. So here again, as well as that level there, I've got those candlesticks, the bodies of the candlesticks themselves will provide support. The 9-day moving average here will provide support. The 26-day moving average here will provide support. The cloud, the top of the cloud, will provide support at that level, and then again at that level. Okay, so all of those, plus to those you're going to add these here. So that moving average support there, 26-day moving average support there, cloud here, support, cloud here, support. So you top them all up and try and see where they cluster, and at the cluster points is where it's likely to work. And I often compare this, and this is the really novel thing in the chart, in that you're looking ahead of time where support will be coming in. You're looking at prices behind time and where support will be coming in. And it's a bit like surfing in Hawaii, where you're in the sea, you're on your surfboard, you're looking behind you to try to get a steer of which is the wave worth catching, worth jumping onto, that's going to give you enough lift to get you going as here, right, the lift that got you going here, and then you're looking ahead of time and say, well, how much lift am I likely to catch going forward? And notice how the cloud starts rallying again here towards the end of the month. Yeah, so that sort of is the idea that you're looking for in the cloud charts. Now, all of this system was based on daily candlesticks, daily moving averages, but I have found in my experience that they work fantastically on a weekly time frame as well. You know, be brave, do experiment. If you want to choose the moving average, change the moving averages, why not? You can do so, although at the moment most people are sticking with convention because they find they've got enough to deal with as it is. But certainly on a weekly time frame, I found them to be excellent, and some of my Japanese spot dealers will use these on an hourly basis. I'm not so sure about this, but certainly on a 4-hourly basis I've been experimenting more recently, and I've found them to be quite successful for the moment. And this is the Nikkei, which is not such a good example because, as we know, the Nikkei has been a very problematic stock index for a very long time. But if I show you the Dow Jones Industrial Average going back to those lows in 2009, I think you'll agree just how much of a lift the clouds did give you here, and again here, and again, and looking forward again and again and again. And so I can totally understand why in the last 4 years or so the whole cloud idea has become far, far more popular with Western analysts, and they've sort of latched on to this one now. So just a final recap of the lines that you're looking at, right? It's the 9-day midpoint, the 26-day midpoint, The 9 plus 26-day moving averages plotted 26 days ahead. The highest high plus the lowest low over a 52-day period, plotted 26 days ahead. And finally, today's closing price, plotted behind today's price action. So those are your 5 lines that make up the system. The more they bunch, the more they join up, as with all technical analysis, the more likely they are to work and be of interest. And if they're very, very dispersed, be careful, careful indeed. Now I'm open to questions from the audience. I suppose you'll write them down for me. And then we'll move on to some current examples, which perhaps Jeff might have to help me set up here from sharing with my screen. As you all know, you might not know, we use the, here at Forex Trading TV, we use the MetaStock Thomson's Reuters icon, which I have used for many, many, many years, or too many years I've used Reuters. And I still think it's about the most comprehensive package you can get. We've launched Forex Trading TV as a tool. Right, I've got a question from George. George, they are not moving averages as we use in the West. They are neither simple nor exponential moving averages. To recap, the 9-day moving average is the midpoint between the highest price of the last 9 days. To that you add the lowest price of the last 9 days, and you divide the number, the sum by 2. Same thing goes for the 26-day moving average, the highest price of the last 26 days. To that you add the lowest price of the last 26 days and divide by 2 and plot it as at today's price. Those are plotted as at today's, as with conventional Western moving averages. Let's see if we've got any more questions while I'm waiting for those. Right. As I'm waiting for the questions here at Forex Trading TV, we've attempted to help you in a live environment. So we've got live prices coming in. We're analyzing them. We watch about 150 charts, currency pairs. We are adding fixed income products. We are adding stock indices and some commodities. Right. Ichimoku looks like a shadow of the current price. Yes, Vij, absolutely right. You're spot on. And it's to do with the concept of the highest high and lowest low over a certain time frame that you're plotting ahead of time. So yes, it's very, very much linked. And the whole underpinning of cloud theory is that time and price is inextricably linked, and that both move in absolute lockstep together. And that's what you're looking at. Time and price inextricably linked, going in lockstep. And yes, you're absolutely right, very much a current shadow of its current self, but it is looking forward. It's forward looking, not looking back in time. LG, you ask, could you walk through an example of where and how you have interpreted a chart in the past? I will be doing several of these with you with current price action. Bear with me a second and we'll work through a number of different cloud examples. Brian, the end of the cloud, i.e. 26 days ahead, is this indicating where the current prices are going? Yes, it's trying to steer you in the right direction. It's trying to steer you and suggest where prices might go. If they don't move in that direction, it's already warning you that things are going wrong, the system is breaking down, and you want might need to revise your medium-term strategy. Again, you'll see with the type of moving averages we're using, this is very much a medium-term trending strategy rather than for intraday purposes. I think you'll have understood that. Kareem, you have a question. How do you think the indicator would work at lower time frames for the minutes, such as minis, such as the ES? I'm not sure what ES is. Minis, I suppose this is small sized futures contracts on maybe the S&P 500 or something like that. Right, okay, here you come back to me. Oh no, it's not Kareem. Yeah, Kareem says yes. Okay, yes, I am Kareem, I'm experimenting on a 4-hourly basis at the moment for the foreign exchange market. I don't really look at the minis as yet. I tend to look at, I'm very much old school banker type, I'm sorry, rather than a day trader. That's not my background. I'm very much a banking background, so I tend to stick with the real McCoy. But certainly on a 4-hour time frame, I'm finding that it does generate signals that capture maybe about a week's worth of trading, so they're quite useful for that. That's the sort of feel I'm getting in the foreign exchange market. Now I've got another comment from, let's have a look. From LG. If you use a shorter time frame, for instance 4 hours, would you suggest adjusting the average calculations relative to the daily charts? I'm not really sure what to suggest here, LG. Obviously, I don't have time to do this sort of analysis. I'd need a research assistant to help me out. If you'd like to volunteer, maybe we could come to some arrangement. But obviously, if you've got a computer that back tests and optimizes any two moving averages, well, it's quite simple to shove it into the computer and it'll spew out all sorts of things. Now I have a caveat here. I have experienced over many years of trying to develop black box systems that you can find some moving average combination that works absolutely beautifully for a bit and then just disintegrates into complete rubbish a couple of years later. So I would say anything that you're optimizing, you've just got to do again and again and again, and constantly you've got to be monitoring the assumptions that you're using. So anyone who tells you that this is the ideal combination for the whatever, S&P 500 minis, beware. Beware. They've probably done this analysis about 10 years ago and they haven't been bothered to go back again because they're too busy trying to sell the system to somebody. So, yeah, big caveat there. Now, Kostas, you have a question. You mentioned on the lower time frames it might work. It might work well in 240 minutes. The question is, on the same midpoints, 26 and 9, yes, at the moment, again, I don't have time to try optimizing all this stuff, but I think the sensible thing to start with would be something along those time frames. So you could try, say, 10 and 20 period or something like that, or just think of the number of hours in the day. So you might want to, in a 4-hour, I mean, basically that boils down to 8 and 24-hour periods, yeah? You could try something like that. That would be a sensible way to look at it in terms of cycle theory, that you're dividing yourself into daily segments which are broken down into 4-hourly segments. So you get this kind of fractal concept coming in with the moving averages that you're using. I think that could be an area of research that you might find interesting and worthwhile. But I myself continue to use the conventional. The reason I tend to use conventional on everything, absolutely everything, stochastics, MACD, you name it, I tend to use everything conventional, is because I find that that is what most other people will be looking at. So I want to try to gauge what Joe Average is going to be looking at, yeah? And so that's why I stick to market convention. But you in your professions, you can feel free to use whatever suits you. Above all, that would be my advice in terms of technical analysis. Find stuff that means something to you, that you find that you can use easily and well, and stick with it and perfect it, and constantly monitor yourself and see whether there's any way you could improve your analysis, which of course would improve your P&L, yeah? Improve your analysis, improve your P&L. So constantly monitor, never get comfortable, never sit fat and tight and think you've got the perfect system, because that doesn't exist. Be hard on yourself. You only can be your harshest critic, as I am. And as I say, once you've found a few of the instruments that tend to work more often than not, stick with them. I often describe it as a dancing partner. When you found the right dancing partner, everything is easy, everything comes easily, and it just sort of flows. And then it'll suddenly break down and everything goes wrong, and you've got two left feet and your partner's an idiot and doesn't get the beat, and things like that. When that happens, just go away and leave it alone. Find another instrument, do something else, just go away and leave it alone, and then come back to it and you'll find it might get easier. Right, Booble, you have a question. Can it be used on minute-based time frame, like 15-minute or 5-minute? Well, again, feel free to experiment. In my experience, I don't really know anybody that's going below a 1-hour time frame. I think there are just too many variables involved here, yeah? Because you've got, imagine, a 5-minute candle with its wicks and its body, moving averages, 2 moving averages over 5-minute period, another 2 lines generated by moving averages, and a 26-minute period times 5. I can't even do the maths in my head at the moment. Plus a lagging 5-minute period. I just think you're going to get yourself into such a knot over such a tiny time frame that I think you'd probably be better off with some other system that's simpler, maybe a MACD or something like that. So just to go on a little bit while we get some more questions coming up here, I can see people are typing in. I watch a lot of charts every day. We produce about 25 to 30 videos in real time, so you can see as the market develops how my thinking goes on. My 2 colleagues here, highly experienced, Alex and Leif, they have different styles. We complement each other's styles. I'm the one who does the clouds. The others 2 like to avoid those and leave them to me. Again, it's this idea, when you find the sort of analysis that suits you, do it. We also, of course, provide headlines. I find the Reuters Newswire is absolutely fantastic, and the searching for stories even better. And generally, with we're covering the major economic releases real time. Comparing the news, how the technical schemes are working out, how they're building, where people are likely to change, the concepts. I mean, the whole idea of Forex Trading TV is that we remove some of the workload for you. We deliver news and videos straight to your PC or your mobile via an app in real time. I mean, do feel free to browse our site and see the type of content we produce throughout the day. You can try our product free for 3 days if you sign up and see how you get on. Right, now Hassan has a question. Is it reliable like MACD and parabolic SAR? Well, what is reliable? Does reliable mean that it gives you good signals or that it gives you lots of signals? Well, I would suggest that people like MACD and parabolic SAR in that they are not subject to interpretation It's either long or short, end of story, get on with it. That is the sort of oscillator, that is the sort of answer that MACD produces and the stop and reverse produces, isn't it, Hassan? Right? It's either go long here and stick with it until I tell you to get out, and then change it. The Ichimoku Cloud, as you can see, is subject to a lot more interpretation. What is the pattern? What is the candlestick? Is the candlestick a powerful reversal chart pattern? Just because it's broken below my 9-day moving average, has the trend turned, or should I sit on it and wait until the 26-day moving average kicks in, which might provide support, and then I'll stay with my position? Can I afford to stay with a position when the Ichimoku Cloud doesn't come in till I don't know how many pips below where I'm currently trading? So as you can see, the cloud type of charting is very, very much more akin to Dow theory, cycle theory, Gann lines and things like this, where you need a lot of experience, a lot of art involved, a lot of art rather than science. It's not a switch you on, switch you off type system, which I believe in the very, very long run will give you the very best investment results. But it's hard work and it's scary all along, and you can never ease up. You're always, every day, every minute having to think on your own 2 feet. Right, now Toast has another question, but perhaps if I use some live charts, it would be more useful. So maybe Jeff could help me set me up onto my monitor, which I will share my screen with you, and we'll start off with a couple maybe of foreign exchange type things, then we'll look at maybe a couple of indices that you might be interested, and see how we get on. So now I've got my screen back, hopefully. I'm wondering if you can see 8 little boxes of charts all packed up neatly on your screens. If you can, no, let's have a look. If you can see little boxed up screens, a large screen divided into 8 little boxes, that's what I'm hoping you might be able to see. Let's have a look.
It's coming through now. Can you hear me, Nicole?
I can hear, yep, let's have a look. What I thought we'd start off with, let's have a look. I thought we'd start with some currencies, and I thought I'd start the euro dollar as the first one, and then I'm going to zoom you in so you can have a look at the chart. And here we have it. This is the daily chart of the euro against the US dollar. Let's have a look. I've lost my interactive question barrier now. Let's have a look where that's gone. But what we're going to start, let me just make sure I've set myself up properly. Right, let's have a look. I hope you've got that. Right, hopefully you can see my chart. This is a daily chart of the euro against the dollar. You can see that as I'm speaking, we've just broken up to 1.3230, 1.323 US dollars per euro, the highest price we've had in a good month or so. We've broken above the top of the cloud, please notice that. Just today, my 9-day moving average has crossed above a horizontal 26-day moving average, and the reason it's horizontal is that that low has stuck there for a long time, and that high has stuck there for a long time, and only now has one of these dropped out, which is that one there. Okay, so suddenly you get this massive whoosh, and we've crossed to a long. Okay, the cloud produced support, the moving average itself produced support over those days over there, and here it was super thin, allowing this enormous burst through this skinny little cloud. The cloud is rising, which has helped inch you up little bit by little bit every day. Unfortunately, it now dips through to the middle of August, which means that we're not going to get the lift that we might have hoped. The lagging span, on the other hand, has little resistance on the way through here. Only the tomorrow's cloud, the clouds really tomorrow and the day after, then it's sort of freewheeling all the way. So that might give you enough of a lift to get going again. Notice also how the lagging line burst through this skinny little cloud over here, allowing you to move higher. But above all, we have to admit that the euro against the dollar has been moving broadly sideways between 128 and 132 for most of the last 4 months. So this is not exactly trending territory. I think you'll agree with me there. Looking to another currency that might be a bit interesting and a bit more difficult to look at, I thought we could look at euro sterling. Again, a daily chart. And again, I think you'll agree with me that we've been trading sideways for an awfully long time, which has meant that the cloud has turned into absolutely nothing. We're going absolutely nowhere, and that we've seen a false break higher, and now we've dropped back down to the 26-day moving average that's barely clinging to support there. It really is a great disappointment and not really one for big moves. Dollar yen, a little bit more interesting. Note how we've got absolutely almost zilch cloud going forward. So no support, no resistance, no nothing to hinder us. So this might be a bit more interesting. Notice how the 9-day moving average is above the 26-day moving average. Both of these pretty flat and going sideways, and not surprising, is it? Because we've been going sideways for a little while now, for a few weeks. Although we had been trending here, we broke below it. Now we're back inside, and the lower edge of the cloud has provided support both here at the beginning of July and also here mid-July. Top of the cloud providing support here, top of the cloud ought to provide support here, but notice that it drifts to zero in the middle of August. Difficult summer markets here in the foreign exchange market. Switching over to some other instruments that you might be interested in, I thought we'd maybe look at the German DAX index. And again, this is a daily chart. I'm sticking to the dailies here. Let's make it life simple. Understand how the daily should move, and then you're free to turn around and test out different things. And you can see that the averages crossed to a sell as we dropped from this year's high. We dropped, sliced right through a relatively thin cloud, which then proceeded to cap the first bounce. It then capped on a second attempt, but now the lower edge of the cloud provided support, provided resistance on that day there, resistance on that day there, but then provided support. The moving averages already have crossed, suggesting a long position. And notice how the lagging span got support from those candles, got support from the descending moving average, and now ought to get support from the 26-day moving average. Let's see how that works. Over here, the current price action ought to get support also from that moving average and the top of the cloud. Rather a long drop if we don't, so just be warned. There you have it. I noticed that Hassan would like to see gold. Let's see if I've got it on this chart or another one. How did I guess somebody would be interested in gold? Here it is. Again, a daily chart. Let's see what we're doing. And I think you'll agree that since December 2012, the moving averages crossed to a short position, and they have been that way around for most, but not all of the time. Notice also that even though the cloud starts off very, very thin, it builds and drops, increasing bearish pressure, carries on for a long time and then suddenly drops in steps, just like the market itself, increases bearish pressure here for this hideous collapse that we saw in April, continued cloud pressure all the way down, increasing here to generate the latest drop, increasing here and really bearing down once again as this bit here kicks in, and it kicks in hard now through to the middle of August. So bearish pressure actually increases over the next 26 days, although the 9-day moving average has just crossed with yesterday's big move. Just because of that move, it has just crossed to a long position, but I think that would be rather suspect, and I wouldn't go with it, as I wouldn't have done on this occasion here when they briefly crossed, and that occasion there when they also briefly crossed. I wouldn't go with that one at all. Looking at another chart that I think you might find interesting, the S&P 500 index. Again, a daily chart, and as I'm sure everyone is all too aware, we are currently trading at a record high. Just, but only just. It's not nearly as record as some might hope, so I'd be rather careful with that. In fact, we are percentage-wise not that much higher than we were in the year 1999 and the beginning of the year 2000. So this stellar performance here is based on the time horizon that you're looking at. The Ichimoku chart at the moment is clearly suggesting a long position with a soaring 9-day moving average, which is trying to keep up with price action, a rising 26-day moving average, which is moving towards the top of the cloud. The only little bit of worrying here that we have is the fact that the cloud gets very, very thin mid-August, so potentially problems mid-August, but notice that it picks up again after that, okay? It picks up and it keeps on rallying, so have a look at that. Also worth noticing that the lagging span has absolutely no problems to it, nothing in its way at all. Also notice how the lagging span got support from this cloud here. Also that the candlesticks there got support from the cloud. Zooming in, you can see what a good job it did there. That was in January 2013. If I flip up to a weekly chart, you will also notice how very, very well indeed, since we first crossed to a bullish moving averages, and that was in March 2009, support there from the top of the cloud, support there from the top of the cloud, support there from the top of the cloud. A bit of a problem here with the moving averages crossing, but eventually it got itself back onto an even keel, and moving averages crossing to a long again, support from the 26-day moving average, capturing yet again the moves and keeping you on a path to higher S&P. I'm afraid, Kareem, I don't have Aussie Swiss set up, and I'm not sure that I've got Aussie Kiwi, but let's have a look at what else you might be interested. Possibly crude oil, anybody? Front month NYMEX contract here. Daily basis. Again, you can see that since the beginning of June, clearly the moving average has been long, very much supporting those couple of dips, soaring higher with a moving average managing to catch up quite well. Nothing stopping, absolutely nothing stopping the lagging span whatsoever. Only trouble is that you're an awful way up from the 26-day moving average, so should we see a bit of slippage, it might be quite expensive to say the least. At the weekly chart, you'll notice that this is not much good at all, because basically crude oil has been trading broadly sideways, front month contract at about the $98 mark, in a broad range between about $78 and $112. So there you have it. We're moving on up to the $110 level. The high over here was $110.55. We've obviously got a problem there, and we're obviously stalling ahead of that. and that's what we've got here. George has a question. In MetaStock, can you plot 26 days ahead? If not, wouldn't the charts look different from the ones you are showing? I think we can plot ahead. I don't usually do it myself.
We're using MetaStock XENITH. There's another MetaStock. We're asking which MetaStock is your favorite.
George, are you referring to MetaStock Pro? What I'm using here is MetaStock XENITH, which is really aimed at the retail market, and that's why we're doing this webinar. But I believe on many of the indices you can plot them ahead of time. I haven't done this so long myself now, I've gone blank, but you can, yes you can, I'm pretty sure you can backdate them. You can backdate any of your charts, or you can push them forward as well. There's a special name for that and I've forgotten the name at the moment. Toast, can we use the eye system to spot reversals, or is it only for trend following? The Ichimoku Cloud system, Toast, was really designed for a trend following system, but occasionally you get very powerful reversal candlesticks which already tell you, listen, we've got a feeling that we're not trending anymore. Best you lighten up at least. And let's not forget, when you're trading, it's not all or nothing. You can start with a small position and try it out. And if you think it's going your way, you can add to your position. And if you get more signals that are helping you, add to it again. And likewise, when you're getting out of a trade, say, look, I've got my first inkling that things aren't going very well. What about reducing? Jeff has said MetaStock Pro does not plot the cloud 26 days ago into the future. However, it is possible to do this in XENITH. All right, there's Jeff, our expert on the MetaStock system. I hope that answers your question. Okay, George. So there we have it. I'm not sure if we're running out of time now. Let's see if there are any other charts. I think the one I'm going to guess would be of interest to you is the yield on benchmark US Treasuries, which I'm sure if you've been reading the news and Mr. Bernanke's frantic backpedaling, you will notice that benchmark yields have risen on 10-year US Treasury paper from 1.6% to a whopping 2.75%, meaning that your US mortgages have got very much more expensive than they were 2 months ago on 30-year fixed ones. What did the Ichimoku Cloud system tell us on these? Well, very quickly indeed, the moving averages crossed, suggesting yields were starting to move higher. Look at that, how quickly. So that's a good example here about, where things can move quickly. Just 4 days after backing up a bit, but still within the range of the previous 3 weeks, moving averages had crossed, warning you things were going wrong. We burst through a super skinny little Ichimoku Cloud, which then the top of that provided support for the next moves. 9-day moving averages zooming higher, 26-day moving average catching up and providing support for the next massive move higher. Once again, the averages coming in and the lagging line having no problem whatsoever, absolutely nothing to stop it. At the moment, slight signs of exhaustion or running out of steam or whatever, in that your 9-day moving average is dropping, although the 26-day one is still supportive. Looking forward, the cloud does continue to lift until mid-August, but then it starts dropping, so again a little inkling. So what you might have been doing here is saying, right, okay, already we've come off by X amount, maybe I should reduce my exposure to half of what I was happy with, or to 1/3 of what I might be doing, and that's a sort of idea that you'd be using with that one. So there we have it. That's another market that I thought you might be worth looking at. The other way, of course, to look at these is with the futures contracts. And here I've got the front month, that's the yield on the German one. I wanted to show you the Bund future, actually. Sorry about that, my mistake. Sorry, slight mistake here. Here's the Bund future. So again, you look at the futures contracts with these, either, you know, the US 10-year, but to do something different, I'm looking at the September 13 German Bund future. And you can see that from a peak in price in May this year, the moving averages crossed to a sell just on the 5th day after peak. Okay, they start coming down quite quickly. That 9-day moving average really capturing most of the move, and then here both the 26-day moving average and the bottom of the cloud kick in. The problem with the futures contracts is that we've constantly, every quarter, we've got a quarterly rollover, haven't we? And it takes quite a long time to get the cloud to build. Yeah, it takes a long time for the cloud to build, and it's just very, very irritating, really. So hence I've tended to work on either the price of the cheapest to deliver or the yield, because that's more useful. But certainly at the moment, the moving averages have turned, suggested you should be long of bunds. We're pushing into a sizable cloud, but not in huge. The 9-day moving average provided support today, as did the bottom of the cloud. And let's see whether this 26-day moving average can catch up and whether we're going to break, because notice that the resistance level is coming down very, very quickly over the rest of this and next week. So that's one to watch out for. And I think those are the examples that I wanted to show you today so far. Let's see if we've got any other questions. Right. Toast has a question about the lagging line explanation. Thank you. Other commentators are suggesting that there is no point to having that on the chart. Absolutely. If you don't like the look of it, don't look at it, ignore it. But that is how the system was developed, and it's always good to know which rules to break when you want to break them, Toast. So, without more ado, I'm going to now hand my screen over to Jeff, who's going to see if there are any more comments he'd like to make, or anything else that needs saying, or any points that I've forgotten. And thank you all for your thanks, vote of confidence, and don't forget that we can work through some of these things, and we can talk you through these with more examples. And I always think that the more you do, the more you'll get a grasp for new concepts.
Okay, Nicole, thank you. That was fabulous. Very enlightening. I had really no idea on Ichimoku, so you've at least educated one person today. I thought it was a great class. Appreciate your having it. Again, the website these guys run is Forex Trading TV, and I believe that is the URL forextrading.tv. If you guys have questions, go ahead and drop us an email. We'll get you in touch with those guys. And really appreciate Nicole for coming in. Probably one of the better classes I've seen in a while. So let's go ahead and we're going to go ahead and break the session for today. If you guys are interested, we are running a little bit of a MetaStock training class in about a half hour. You can stick around for that. Actually, I be wrong on that time frame. But I appreciate your time this morning. Thanks for coming in. And we'll see you at the next one. Thank you.